Picture this. Sarah from Toronto just got the letter every homeowner dreads. Her mortgage is up for renewal next year, and her monthly payment is jumping from $2,800 to $3,400. That's an extra $7,200 per year. She's not alone. The Bank of Canada just confirmed that 60% of Canadian homeowners renewing their mortgages in 2025 and 2026 will face higher payments, even with recent rate cuts. But why is this happening when everyone said rates were coming down? The mortgage crisis hitting Canadian families right now. I will share 10 deep reasons, but don't miss the reason no 2, because it can be problem-solving. Number 10. The interest rate roller coaster legacy. Here's something that will shock you about Canada's interest rate journey. Just 2 years ago, the Bank of Canada's overnight rate was sitting at a historic low of 0.25%. Fast forward to today, and despite recent cuts bringing it down to 2.50%, millions of Canadians are still trapped in what experts call the mortgage renewal cliff. When homeowners locked in their mortgages during the pandemic at rates as low as 1.5%, they had no idea what was coming. The brutal reality is that even with the recent rate cuts, anyone renewing today faces rates that are still double or triple what they originally paid. This creates a devastating payment shock that's rippling through households across the country. The psychological impact is crushing families who thought they had their finances under control. What makes this even more terrifying is that most Canadians have no idea how much worse it could get if economic conditions shift again. Number 9. The mortgage stress test trap. The mortgage stress test was supposed to protect Canadians, but it's become a double-edged sword that's slicing through homeownership dreams. Here's the twist nobody talks about. Qualifying at 5.25% when rates were low seemed manageable. But now that actual rates are climbing toward that stress test level, families are discovering they're living right at their financial breaking point. The government recently announced changes allowing some borrowers to skip the stress test when switching lenders at renewal, but this creates a dangerous illusion of relief. What's really happening is that homeowners are becoming prisoners of their current lenders, unable to shop around for better rates because they can't qualify elsewhere. This lack of competition means lenders can offer whatever rates they want to trapped customers. The most shocking part? Many homeowners who passed the stress test years ago wouldn't qualify for their own mortgage today at current income levels and housing prices. Number 8. The regional payment shock divide. Not all Canadian cities are experiencing this mortgage crisis equally, and the differences will astound you. In Vancouver, where the average home price exceeds $1.2 million, mortgage holders facing renewal are looking at payment increases that could exceed $1,500 per month. Toronto homeowners aren't far behind, with typical payment jumps ranging from $800 to $12,200 monthly. But here's where it gets interesting. Cities like Calgary and Edmonton are seeing more moderate increases of $400 to $600 per month. Yet this still represents a crushing burden for families already stretched thin. The Atlantic provinces are experiencing a unique phenomenon where rapid home price appreciation during the pandemic means even modest rate increases translate to significant payment shocks for recent buyers. What's most disturbing is that these regional differences are creating a two-tier system where your postal code determines your financial survival chances. Number 7. The variable rate victim phenomenon. Variable rate mortgage holders have been living through a financial nightmare that fixed-rate borrowers are only now beginning to understand. Since 2022, these homeowners have watched their payments climb month after month, with some seeing increases of over $1,000 per month from their original payments. Many reached their trigger rates and payment caps, meaning they were making payments that didn't even cover the interest, causing their mortgage balance to actually grow larger. Now, as these mortgages come up for renewal, these borrowers face a double shock. They owe more than they originally borrowed, and they need to qualify at today's higher rates. The psychological toll has been devastating, with many variable rate holders reporting stress, anxiety, and relationship strain. What's particularly cruel is that some of these borrowers were advised by their banks that variable rates were the smart choice just a few years ago. Number 6. The new build nightmare. The government's recent announcement of 30-year amortizations for new builds was supposed to help, but it's creating an unexpected mortgage payment crisis. Here's why this is backfiring. Builders are using these longer amortizations to justify even higher home prices, meaning buyers are paying more for homes and still facing significant payment increases at renewal time. New build buyers are particularly vulnerable because they often purchase before construction is complete, locking in mortgage rates that may be obsolete by the time they take possession. Construction delays, which have become common, mean buyers are getting homes 6 to 12 months later than expected, often forcing them into higher-rate environments. The 30-year amortization might lower initial payments, but it means homeowners will pay substantially more interest over the life of the mortgage, creating a generational debt burden. Most shocking of all, many new build buyers don't realize that their mortgage payments will still jump significantly at their first renewal, regardless of the longer amortization. Number 5. The hidden inflation impact. While everyone focuses on interest rates, there's a hidden factor driving mortgage payments higher that most Canadians don't even realize. Property taxes have been skyrocketing across the country, with some municipalities seeing increases of 15 to 25% in recent years. Home insurance premiums have exploded due to climate-related claims, with some homeowners seeing their insurance costs double or triple. Utility costs have surged, and for many Canadians, these are included in their total housing payment calculations. When lenders evaluate mortgage affordability, they look at your total debt service ratio, which includes these rising costs. This means that even if your mortgage rate stayed the same, your qualifying power has diminished significantly due to these other factors. The most frustrating part is that homeowners who were comfortably within their budget 2 years ago are now struggling to make ends meet, not just because of their mortgage, but because every aspect of homeownership has become more expensive. Number 4. The income qualification crisis. Here's a reality that's shocking Canadians. Many homeowners wouldn't qualify for their own mortgage if they applied today, even at current rates. Lending standards have tightened dramatically, with banks requiring higher credit scores and more documentation than they did just 2 years ago. The rise of gig economy work and contract employment means many Canadians who were qualified borrowers before are now considered higher risk. Self-employed Canadians, who make up a significant portion of the workforce, are finding it nearly impossible to qualify for competitive rates, forcing them into alternative lending products with much higher costs. Employment uncertainty has made banks more conservative, meaning they're requiring larger down payments and higher income multiples. What's most disturbing is that this creates a system where existing homeowners become trapped in their current mortgages, unable to move or upgrade even if their life circumstances change. Number 3. The renewal rate shock reality. The Bank of Canada's own analysis reveals a timeline of payment increases that will devastate household budgets across the country. In 2025, homeowners renewing their mortgages will see average payment increases of 10% compared to their current payments. By 2026, this jumps to even higher percentages as more mortgages signed during the ultra-low rate period come due for renewal. What makes this particularly cruel is that these increases are occurring during a period of high inflation and cost of living pressures, meaning families are getting squeezed from multiple directions. The psychological impact cannot be overstated. Families who thought they had achieved the Canadian dream of homeownership are now questioning whether they can afford to keep their homes. Many are being forced to consider selling, but with a sluggish housing market, they may find themselves trapped with homes that have decreased in value while their mortgage debt remains high. Number 2. The generation divide catastrophe. The mortgage payment crisis is creating an unprecedented generational wealth divide that could reshape Canadian society. Baby boomers who bought their homes decades ago and have small mortgages or own their homes outright are watching their property values remain relatively stable while their housing costs are minimal. Generation X homeowners who bought before the massive price appreciation are facing manageable payment increases at renewal. But millennials and Gen Z homeowners who entered the market during peak prices with maximum mortgages are facing financial ruin. Many young families are discovering that the mortgage payments they could barely afford at low rates are becoming completely unmanageable. This is forcing an entire generation to make impossible choices, drastically reduce their standard of living, move far from employment centers, or give up homeownership entirely. The long-term social and economic implications are staggering, as this could create a permanent rental class among younger Canadians. Number 1. The perfect storm convergence. The number one reason mortgage payments are rising across Canada isn't just one factor, it's the convergence of multiple crises creating a perfect storm. Interest rates that remain elevated compared to pandemic levels, housing prices that haven't corrected proportionally to rate increases, stagnant wage growth that hasn't kept pace with housing costs, and tightened lending standards that trap homeowners with their current lenders. Add to this the psychological factor. Fear is driving the market, with both buyers and sellers paralyzed by uncertainty, creating artificial scarcity and price support. The most shocking revelation is that this crisis was entirely predictable and preventable, yet policymakers seem caught off guard by the severity of the impact on ordinary Canadian families. What makes this the perfect storm is that each element reinforces the others, creating a downward spiral that could take years to resolve. The human cost is immeasurable, with families across the country facing the very real possibility of losing their homes, not because they made poor financial decisions, but because the economic system failed them. So there you have it, the 10 crushing realities behind Canada's mortgage payment crisis. From coast to coast, families are struggling with a perfect storm of economic factors beyond their control. If you're facing mortgage renewal or thinking about buying, make sure to subscribe and hit that notification bell. We'll keep tracking this crisis and bring you the latest updates on Canada's housing market. What's your mortgage situation looking like? Share your story in the comments below.